For decades, it's been the golden rule of investing. It's probably the first piece of advice anyone ever got about building a portfolio. But what if that bedrock foundation has a massive crack in it? What if the one strategy that was supposed to protect you is actually the very thing putting you in harm's way? Okay, let's get right into this because we're about to challenge everything you think you know about building a portfolio for the future.
Wow. This quote really says it all, doesn't it? The entire game has changed. That simple, beautiful balance that was designed to give you growth while protecting you from risk, it's fundamentally broken. And this isn't just about a bad year or two of returns. We're talking about a structural failure in a system that millions of people still trust with everything they have. So we really need to understand what went wrong.
For the longest time, the logic was just brilliant in its simplicity. You'd put 60% of your money into stocks for that long-term growth. And then you'd put the other 40% into super safe, high-quality bonds to act as a kind of shock absorber. The idea was, when stocks inevitably took a nosedive, your bonds would hold steady, or even go up. You just rebalance once in a while, and for decades, man, it worked like a charm.
But here's the thing. What worked in the past isn't guaranteed to work in the future. So today, we're basically performing an autopsy on this old investing standard. And the conclusion is, well, it's pretty clear. The classic 60-40 portfolio, as we all knew and loved it, is dead. Understanding why it died is the absolute first step to protecting yourself going forward.
So the whole engine that made this thing run was something called inverse correlation. Just think of it like a seesaw, right? When the stock market side went plunging down, nervous investors would rush over to the safety of bonds, which would push the bond side up. This opposite relationship was the portfolio's built-in defense mechanism. It was the entire hedge.
And this is the question that changes everything. What happens when that seesaw just breaks? When both sides, your growth engine and your safety net, start crashing down at the exact same time? All of a sudden, that protection is just gone. The part of your portfolio you counted on to save you is falling right alongside the risky part. This brings us to the new and honestly kinda scary reality for investors today. That reliable inverse correlation we all depended on, it's pretty much over. We are now living in a world of positive correlation, and the implications are just massive. Let's actually look at the data. This slide just lays it out perfectly. The old rule, the one on the left, was inverse correlation. Stocks zigged, bonds zagged. Easy. But now, look at the new reality, positive correlation. They often fall together. U.S. Treasury bonds, which were supposed to be the ultimate safe haven, well, we've seen them get sold off hard during market chaos. The automatic stabilizer is just broken.
This quote right here is the brutal truth of it. When all your assets are moving in lockstep, your diversification is basically an illusion. Yeah, you might own a bunch of different things, but if they all go down when the market goes down, you are completely 100% exposed. There is no place left to hide.
So the most important takeaway here is that your portfolio's brake pedal has been cut. Imagine driving a car where someone wired the accelerator and the brake together. That's the danger of a 60-40 portfolio today. When fear hits the market, everything can just plummet all at once, leaving you totally helpless. Okay, so the old model is toast. But hey, panicking is not a strategy, right? It's time to adapt. It's time to build a portfolio that's designed for the world we live in now, not the world of 30 years ago. So let's dig into what a more resilient, modern portfolio actually looks like. All right, so here it is, the modern, more robust allocation, the 50-30-20 split. So what we're doing is we're reducing our reliance on stocks down to 50%, we're dialing back bonds to 30%, and then we introduce this absolutely critical third piece, a 20% allocation to what are called alternatives. Now, this isn't just a tiny adjustment, it's a fundamental shift in how you should think about building your portfolio.
So why does this work? It's because that 20% slice is specifically designed to be non-correlated. It's an asset class that basically dances to the beat of its own drum. It doesn't really care what the stock and bond markets are doing on any given day. And that right there reintroduces true diversification back into your portfolio. It gives you a new, more reliable brake pedal.
Okay, so what in the world are these alternatives? I know it sounds kind of fancy and complicated, but it's not. This isn't about some risky, confusing financial product. It's really just about adding tangible, real-world assets to your portfolio that behave differently than paper assets like stocks and bonds. Let's break it down. So alternatives are things that just don't move in lockstep with the markets. Think about things like gold or other commodities. But one of the most powerful and accessible alternatives for most people is real estate. It's a tangible asset, right? You can see it, you can touch it, and its value isn't just dictated by a bunch of traders on Wall Street. Yeah, let's focus on real estate for a second, because it really shows off a huge advantage of alternatives. You're in control. See, when you own a stock, you're just a passenger. You're just hoping the CEO makes good decisions. But with an investment property, you're in the driver's seat. You can directly influence its value, you can increase its cash flow, you have control.
And a perfect example of this control in action is a strategy called the BRRRR method. It's an acronym. You buy a distressed property, you rehab it to force its value up, you rent it out for steady cash flow, you refinance to pull all your initial investment back out, and then you repeat the whole process. The key here is that this is an engine for building wealth that has absolutely nothing to do with what the S&P 500 is doing that day.
And hey, this isn't just some theory. There are real-world opportunities and alternatives happening right now. For example, there's a massive 1.8 times trillion dollar wall of maturity in commercial real estate debt that's all coming due by 2026. Now, that's likely going to create a lot of distress and a ton of opportunity for investors who are prepared to jump in.
So adding alternatives like real estate, that's one really strong layer of defense. But we can also use some more tactical tools to actively manage risk inside our stock allocation. And one of the most powerful ways to do that is to actually use market fear itself as a hedge.
So let me introduce you to the VIX. The official name is the CVOE Volatility Index, but pretty much everyone just calls it the Fear Index. And the way it works is actually really simple. When investors are panicking and the market is going crazy, the VIX goes way up. When everything's calm and quiet, the VIX drifts down. It's literally a real-time measurement of fear in the market. Now look at this relationship. This is that powerful inverse correlation we used to get from bonds, but on steroids. When the S&P 500 drops, let's say by 15%, an ETF that tracks the VIX, something like VXX, is designed to spike, sometimes by 100% or more. It's a direct hedge against a market crash. Now, of course, when the market goes back up, the VXX goes down. That's why it acts exactly like an insurance policy.
The source material really puts it perfectly. This isn't something you buy and hold forever. It's a tactical tool. It's an insurance policy. You pay a premium for it, and it does have a cost. It tends to decay over time. But when you really need it, when the market is falling apart, the payoff can be huge and can really protect your portfolio from some serious damage. It's all about actively managing your risk.
All right, finally, let's talk about one of the most common mistakes that even really smart investors make. It has to do with the simple act of rebalancing your portfolio, and how, in this new world, most people are doing it completely wrong.
The old way of rebalancing was totally robotic, right? You just sell your winners to buy more of your losers. Simple. But the smart, modern way is analytical. Before you even think about buying more of something that's down, you have to stop and ask the most important question. Why is it down? Has the fundamental reason I bought this thing in the first place completely died? The brutal truth is that some things go down and they never come back. And blindly rebalancing into a broken asset isn't a strategy, it's just throwing good money after bad.
So as we wrap this all up, there's really only one question you need to ask yourself. Is your portfolio built for the last decade, or is it built for the next one? The old 60-40 relied on a relationship between stocks and bonds that is fundamentally broken. The modern portfolio adapts with that 50-30-20 structure. It adds non-correlated alternatives. It uses tactical hedges like the VIX, and it rebalances with your brain, not on autopilot. The world has changed. The question is your portfolio ready for it?